If you're trying to avoid a debt after it's happened, then too late. But if your intention is asset protection beforehand, then it's very different, isn't it?
So the big question is this: how are investors like us who weren't born with a silver spoon successfully investing in property to create a passive income and still have a lifestyle now? That is the question. This podcast will give you the answers. I'm George Markowski and welcome to the Positive Property Show. Our mission is to empower 10,000 people to create financial freedom through property using the Markowski method. Join us.
Hello, everyone. How is everyone tonight? Tonight's all about asset protection, guys. You know, it's a big thing. It's important to a lot of people. And basically, if you're going to be building your empire, you want to protect your empire. And Adrian is part of the circle of safety. So guys, you know, he's here for you guys. And I've spoken to Adrian, and because he's a circle of safety, we're going to be organizing something really special for you guys tonight that Adrian's going to offer you guys being live with us tonight, which is pretty cool. So we're talking about asset protection, and this is our monthly Sherp. And what I'd like to do is I want to sort of kick into high gear. We're going to go in a little bit quicker. I was going to do a quick summary of what we did before and then go through it all. So Adrian, welcome.
All right, thank you. I'm just making sure that I'm on live again.
Yep, fantastic.
So let's just go through where I was saying before, and because I understand that we've got some new people and some not. So asset protection is very easy if you do it beforehand. Asset protection is and keeping your assets is very difficult if you don't do it beforehand. That's what it comes down to. Now, I've got a client at the moment who has a very large property empire, huge, like worth a lot of money, and he has acquired this property over a long time, and it's a total mess. It's got dozens of properties in his own name, some across other entities. There's loans, and it was unfortunately did really badly out of the COVID lockdowns last year. Had some commercial tenants who have stopped paying, lost a lot of money, and now I am going to save him very large amounts of money and help him keep the furniture, but he's lost insane amounts of money. And now he can afford to pay me a lot because he's very wealthy, and has now become a lot less wealthy. But we're saving that now. Kind of what we're the amounts of money he's paying me is mind blowing because of things are so complex and there's so much money at risk. Now, if I've only been working for him as a client for a number of years, like 7 years, and has accumulated a property over 40 years. If I'd been working, or if he had structured things in a reasonable way, or in an asset protective way over that time, probably wouldn't need me, or probably wouldn't need this advice. Now, so if you are really, really wealthy, you can probably afford to burn huge amounts of money if you and do asset protection at the last minute. On the other hand, if you're if you're reasonably successful and you don't want to lose your assets, it's so much more worthwhile doing it ahead of time. And even reasonably successful isn't, maybe you've got a couple of properties. Maybe you've got, I had someone who lost a whole bunch of money in some business interests, and their business partner sued them. In fact, I've got a number of war stories. Things are doing bad at the moment. I said this in an the earlier session, that I would say about 80% of my clients are doing exceedingly well. Like just the last 12 months have been like just the best that they've ever had. I had one client who did, whose sales increased 3,500% when lockdowns happened because they sold something online and it was something people liked. On the other hand, there's about 20% of clients that I see who are doing really badly. If you're in airlines, you're in travel, you are in a very bad position, and so you could be affected. I've dealing with a client at the moment, and he became he actually had his things fairly well protected, or he didn't have a lot of he wasn't doing anything really risky, so he has some assets in his name, and now a couple of years ago became a director of a company. Wasn't tremendously involved in it. They ended up having a falling out with the, other members, and now he's suddenly being sued for a large amount of money, and we're scrambling to move things out of his name. Scrambling at last minute, much harder. Now, I mentioned before that like the easiest strategies, strategy number one is you want to hold something in the safest spouse's name. So now I'm a lawyer, and I have so as a professional, I'm at risk. I'm also director of a number of companies, so therefore I'm at risk there. I'm at risk of being. I'll repeat what I said before. Is I'm at risk of being. We're having adverse tax debts, of being seen as a shadow director, of being sued professionally, and therefore I'm a risky person. My wife, she works in a hospital. She's a speech pathologist. She is almost at nil risk of being sued. Now, if in 5-10 years' time she decides to run a business or change her careers, then we'd need to look at what she's doing again. So asset protection is something that you need to constantly think about. When you have a change in life circumstances. So we bought a house. It's in my wife's name. I own nothing. Just like George mentioned, the Simpsons, Mr. Burns doesn't own anything. It's owned by a canary.
Now, so I'd like to make a quick summary just for people that didn't join us the last session. So what we did is we spoke about different occupations, and we spoke about how owning a business, being a professional, being a high-income person can leave you vulnerable to getting sued. We also spoke about, as Adrian mentioned now, is that doing asset protection early on, and also getting the right expert, is very, very important, because you can save a lot of money and a lot of time by doing it right from the beginning. Because like Adrian said, once the horse is bolted out the gate, it makes it very expensive, very difficult, if possible at all. Sometimes it's impossible, because what happens is they can actually go back 12 months, 18 months after you've set up a trust and actually dismantle it or something like that, can't they, Adrian?
Yes, yeah, that's right. So if you're suddenly doing transactions just before bankruptcy or before a company goes into liquidation, it can be undone 6 months, 18 months beforehand. So whereas if you transfer assets, if you bought it to start off with in a family trust, that can't be undone. It was always that way, even if you go bankrupt later. But if it's in your name and you transfer it into a family trust, that transfer can be undone, like as if it never happened.
Yep. So that's why the earlier you do it, and obviously your intention when you do it is the important part. Because yes, if you're trying to avoid a debt after it's happened, then too late. But if your intention is asset protection beforehand, then it's very different, isn't it?
Correct. And you do these things for a number of purposes: asset protection, for tax, and for estate planning. So you're going to want to make sure that you put things into a trust, and so you could say this trust will go to my first child, and the second trust will go to my second child, and so on. And that way, what's the reason why you're doing this? Well, is it to evade creditors? No. It's for like legitimate asset protection. You want to keep a distance between risky assets and passive assets. And property is a passive asset. It's not risky.
No, where
It's
is a risky asset.
a business, being a professional. That's a risky asset. Or even being or even having a bad relationship is a risky asset.
Yes. So basically, what we're trying to do is quarantine the risk away from the rest of the income producing assets and all the other assets. Is that correct, Adrian?
Correct.
Yep.
Absolutely.
You mentioned before that you can actually create a trust and get tax deductions at the same time.
Yeah. So we went before we went through a family trust, and so let me bring up the whiteboard again. Okay. So and I just saw a message saying, will I go through the benefits of a family trust? Well, yeah. So let's go through this. So there's advantages and disadvantages of this. So let's say we have a family trust, and this owns some property. Now, the family trust is going to borrow, let's say this is $500,000, and you've got, say, what, $100,000 equity, and you've borrowed $400,000 from the bank. So what's going to happen is, this is your $100,000 worth of assets. Now you're going to make, say, like $10,000 profit on this each year. What would you say, George, on current interest rates? Would this be positively or negatively geared on average? You're the property guy. Oh, George, you're on mute.
So you got a $500,000 property, $400,000 loan. What's going to happen is it's going to be slightly negative until we get depreciation, and depreciation is going to make it positive. So on this property here, we're going to be depreciating $12,000 in the first year.
Yep. Cool.
Therefore, we really want to get that money back of that depreciation, because on average, we're getting about $80,000 in the first 10 years from a $500,000 property.
Gotcha. And so we've got so with $12,000 depreciation, we're going to have, say, $25,000 income. And what are our interest costs at present?
Okay, at the present, they're pretty low. But what I'd like to do is open up a cash flow calculator and go through a live example of this.
Yep.
Because that way we could talk something real. Just open up a cash flow calculator here, and I'll chuck in the numbers because I've got everything in there. Should have prepared one earlier, but we'll get there.
Oh, that's all right. I
haven't done one of these for a while because the coaches do it, but I'm just trying to get one open. That's an Excel, and a new one that we've done recently. Cash flow.
Than my just rough figures here.
Yeah, let's just do rough figures because
it
is what it is. So basically what's going to happen is the property is going to be negative, probably about $80 a week. Then you're going to get your, let's say $50 a week. Then you're going to get your depreciation. It's going to make it positive.
And how much is that? That's going to be something like $15,000 interest.
400,000 at 3.5%. Probably 14,000 interest. Yep.
Cool. So that way it's slightly negative. So it's cash flow positive, but so we've got 25,000. So 25 minus 15 minus so 25 minus 15 equals, you've got $10,000 cash. But then you're going to say minus 12 equals $0 tax. Okay, so you're actually making slight losses in there.
Yes.
So
on paper anyway, making loss of paper.
yeah, you're making paper losses. Now, so this is tax negatively geared. So this is the one of the disadvantages of a trust, in that loss, that $2,000 tax loss is trapped in the trust.
Yep.
It's trapped there. So if you're making, say you got a husband and a wife, and I'll use the example I used before. The husband's making $80,000 a year, and the wife is making $40,000 a year because she's working part time. And you'd say, cool. Well, the ideal scenario is if we could, minus $2,000 on the husband's income, which is going to get you about $600 cash back.
Yeah. Well, what we want to do really is we're going to try to get the whole 12K off his income.
Oh yeah. So
let's
start.
So let's say we've got 12,000 paper loss. Remember, it's a paper loss, not a real one.
Correct.
So 12,000 times 37%. So that's what we're trying to really get at the end of the day.
Yes. Yep. Well, except that offsets his $10,000 income. Yeah. So we've got a $2,000, we've essentially, there's $600 worth of cash that's sort of trapped in the family trust. That's the negative of it in this scenario. Yeah, now, over time, as you pay the loan down.
If I can just jump in for a second, it's going to be more than that. It's because with a property like this, because normally what we do is use equity. So we've got a whole loan of $500,000 plus stamps and legals. So it's actually going to be around break even or minus $1,000 or $2,000 without the negative gearing. So we're going to be losing between 12 to 14,000 on paper.
Yep.
And that's why we've got that 12 to 14 grand stuck in the family trust, which we don't want stuck there.
So let me show you how to get around that.
Great.
That's why we're here. So let's just say, so the husband is on $80,000, and so how much did you say they're going to borrow? Let's just use the same example. He borrows 400,000.
500,000.
He borrows 500,000. Yep, cool. And because he's got equity in something else that he's using.
Yeah.
Cool. So he's going to borrow $500,000 from the bank. And so what he's going to do is he is going to, we're going to buy this property in a unit trust.
Mm-hmm.
Now this is a special unit trust. This is not a garden variety unit trust. The unit trust buys this property. Mm-hmm. Now the husband, he is going to invest in this. He's going to invest for 500,000 units in there. Now he has the right to all of the income and capital of this. This is going to be deductible for him. So now what's going to happen here at the trust level, they're going to get $25,000 income minus $12,000 depreciation. And then, but now he is going to get, what would we say, like $20,000 interest, let's just say. So now, so what's going to happen is there's going to be a profit of $13,000 paid to him each year.
That please.
So he's going to have $13,000 profit paid to him, but he's going to get a $20,000 deduction. So he's going to get a total $7,000 reduction which in real terms means he's going to make probably about about $3,000 from this structure each year. And all we've done is just fiddled with the structure. Now, I want someone who's thinking of the asset protection to tell me the problem with this. Because there is one glaring problem, which I'll then show you how to fix. Who can see the problem? So he has units. Oh, was someone? Was that someone there?
That's someone just joining us.
Okay.
So he owns 500,000 units.
Units, yep.
And he's got an asset there, hasn't he?
He has a $500,000 asset. It's as if he owns it in his own name. So if he went bankrupt, the trustee in bankruptcy would take these units off him.
Yep.
That's right. Yeah, cool. I can see that. Hi, Lisa. Yeah, I can see absolutely that is his problem. It is not protected. Mm-hmm. So what we can do, so you cannot use a garden variety unit trust to do this. What we would do though, is we're going to have one unit issued over here to a family trust. Now, and we're going to change these, or these are not ordinary units. These are capital protected units. Mm-hmm. Special units. And these units say that he has the right to the income in the capital unless he is the subject of matrimonial attack or bankruptcy. And I just saw a question that popped up that said, is a unit trust like a company? Yeah, conceptually, it's the trust that is the most similar to a company.
Trustee. Is a unit trust similar, same as a corporate trustee?
No. A corporate trustee is the person who holds the property for the benefit of the trust. And they don't really do anything though. Remember when I said that trusts were set up in, came into being in the Crusades when the Crusaders went off to the Holy Lands, but someone had to hold their castles. They didn't have companies back then, and so what they did is they got a trusted friend and they transfer the title into the trusted friend's name, and then that person would hold it for the benefit of their families, their children, etc., until they return from the Crusades. And so so the trust. Hello. So the trustee is the person who holds the property on the trust. So technically here there is a corporate trustee. But we don't really need to worry about that. So there's like the corporate trustee is actually the person who's on the title of the property, and they're holding that property for your benefit or the benefit of whoever is listed in the trust. So it's kind of the corporate trustee plus the unit trust. That's what makes up the unit trust. So now here, so let's go back to these capital protected units. So now he gets the benefit of this house and $7,000 tax deduction there versus only a couple thousand dollars lost in the discretionary trust. So he's getting his negative gearing. He's still making the same income. He's still making positive $13,000. And if he goes bankrupt, he loses out. So these units, he loses his interest to them until he's not bankrupt. And this family trust here has the rights to the property. Now, who's familiar with land tax in South Australia? Oh, sorry. Actually, why don't I just ask? Just pull up some of these. There's another couple of chat questions that have come up. So Ryan Bowles, hi Ryan, says, is a unit trust similar, the same as a corporate trustee? No, your setup looks like a corporate, so a company with a corporate / corporate trustee and the trust. Yes, that's a very standard setup here. Now, Lisa has said, but doesn't his personal tax liability go up? No. What happens there is he has, so there's $25,000 income made by the property, minus $12,000 of depreciation, and so then he gets $13,000 of income, but so his income does go from $80,000 to $93,000. So you're right. Thank you for paying attention there. But he's also got $20,000 of interest deduction. So his income goes from 93 down to 73, which is $7,000 less. So that's how I've arrived at that. So his personal tax liability goes down.
Absolutely. So, we'll keep that depreciation for the next 10 years. So
correct. Yeah. And so so something else that's cool. So I was just saying, so in South Australia, the land tax. Now, let's just say, instead of being an investment property, this was his principal place of residence. So if your principal place of residence was owned in a family trust, what do people think? Do you have to pay land tax on it?
Well, I bet with a lawyer like you, probably not, but otherwise you would have to.
Yeah, yes. So with a family trust, you'd have to. But the way the rules are designed, and they're only 9 months old, these rules, the new land tax changes, with this unit trust, this capital protected unit trust, if this was his family home, he would not have to pay land tax on this property. So it's protected, and he gets the land tax exemption.
And I'd assume he wouldn't have to pay any capital gains once he sold it either.
Yeah, what we'd need to do there is we do a special lease, which I call the main residence lease. Do you want me to explain that one? Maybe start a fresh one.
Want to hear it, guys? The main lease. We're getting
main residence lease.
I like it. It's getting. Yep, we do.
Yes, cool. So first of all, so what we're doing here. So let's just go back. This works with any kind of trust. So now Ravi has just said, can I transfer my property to a trust and then rent it out back to me? Yes. The problem that it's going to occur is that you have stamp duty on the transfer. So you really want to work out how to do the asset protection without incurring transaction costs. Like, you don't want to pay $20,000 of stamp duty.
No, exactly. That defeats the purpose. Ken also said, so is the bank loaning the money to the unit trust or the actual person?
So Ken said, so is the bank, Ken said, how does the unit trust achieve a borrowing capacity, and is the bank loaning the money to the unit trust or the actual person? So in the example that I was giving, the person is borrowing the money, and the trust is buying it and going guarantor. Now in this was actually in this unit trust scenario, the bank gets a mortgage over the house, and they are lending money to an individual, and like that's quite simple.
Yep. Lisa asked a question as well. Can you set this type of structure up retrospectively? You can money though. That's the problem.
Yeah. So you could. It's stamp duty is the real killer in these. So if you've got, sorry,
it's probably not worth it once you've done it, because I think what you explained, once you go through the scenario, if you can explain how you can borrow money, your family trust can get a loan against your equity, that's probably the best thing to do retrospectively.
Yeah, let's just go over that. And I went through this with the earlier one. So let's just say instead of, so I'm going to go over what I went in the earlier seminar, but we're going to go into a bit more detail in this. So let's just say I had, so husband and wife had purchased the property in their name jointly, which, you know, maybe they weren't in particularly risky circumstances and now things have changed, or maybe they've just become more aware of asset protection. And so let's just say we've got a $500,000 property. They've got, you know, $200,000 of equity and $300,000 owed to the bank. What we're going to do is we need to protect this equity here. So what's going to happen is your family trust is going to write you a check for $200,000. Okay, and in return for that payment of $200,000, you're going to give them a mortgage, okay, of over that money, and you're going to have to pay it back at some stage. And then, now that you've got this check for $200,000, what are you going to do with this? You're going to gift it to the trust. So, so then the check's done. It doesn't need to be presented, but now we have moved effectively $200,000 from your personal name into the name of the trust. Now, so this is I usually suggest this if you've purchased property in this way and you're trying to protect it later. So now this way, if the husband goes bankrupt, and 90% of bankruptcies are men, then what the trustee in bankruptcy will look at his list of assets. They will see that he is on the title for this, but the trustee will in bankruptcy will say this has no value, and then allow the wife to buy it off them for whatever the value is. Now maybe let's say the property goes up and it's worth $510,000. Then maybe the wife has to buy it off the trustee in bankruptcy for $10,000. You've lost $10,000 rather than $200,000. Generally, what we do is we put interest on this amount and try and match that interest with the increase in value of the property. So there's never any equity. Sometimes there's a little bit of gap there, you know. So this is what you do to if you've got the property in your name. Now, from an asset protection point of view, this is very strong. I've seen this like defended a number of times. I literally have 3 matters like this on my desk at the moment, where this has been set up and the trustee in bankruptcy is attacking it. 2 of them, it's fine. One of them, they drafted it themselves, and the wife drafted it, and unfortunately it wasn't drafted well, and they went to a conveyancer and they lodged it, and so we've had to have a big fight with the trustee in bankruptcy over whether we can protect the asset. And I'm hopeful that we'll be successful, but it's not clear because they drafted it themselves. But it's
to draft it for you. Now, but in the case, and what about when you want to use equity to purchase another investment property? Well, in this scenario here, it's very easy to do because you got the flexibility. Is that right?
Correct.
So if
now
it goes up 200 grand, we can still use this equity and get a loan, can't
correct. Now this can be an unregistered mortgage, so your bank doesn't need to see this.
I don't even know this.
Just correct. Now, Ravi, you said in the earlier session it was shown there is a way to save stamp duty and transfer current owned property to a trust. No, what I said is that we can transfer current owned property between the husband and the wife.
Yeah, you can do it to a spouse, but not to a trust.
Yep. And now Ryan says, for married couples, first property, both working in the business together, do you recommend joint tenants or tenants in common? Now, My pleasure, Ravi. Happy to clarify. Now, Ryan, do you recommend joint tenants or tenants in common? Now, if you're both working in the business together, you are both at risk. Now, if it was just the husband working in the business and the wife not, the easiest thing to do is the wife purchases the property in her name. It's really simple. The second best thing to do is a tenancy in common. Well, it's not maybe second best, it's like third best or something, but it's worse. The worst is joint tenancy, which is the default when you purchase property. So I just want to say, husband and wife are purchasing a property. A joint tenancy. The joint tenancy means that whoever survives, who dies last, gets the whole of the property. Now that's really convenient from an asset, like an estate planning perspective, because it just goes to the other person. That's simple. But it means that if the husband goes bankrupt, the trustee in bankruptcy can take 100% of the property. Now, sometimes there are some arguments that you can run afterwards, that the wife has contributed, and like it could be very difficult though. Like the trustee in bankruptcy will go after 100% of the property though. A joint tenancy, tenants
in common.
Tenants in common. Tenants in common. That means that you each have a, to say 50% each, you have a specific percentage, just like you might have shares in a company or units in a unit trust, you have a percentage of this property and that's yours. And it could be 50, 40, 30, 10, 5, 1, whatever. And that is your property and you don't have any entitlement to anything else. And what happens is then if you die, that property goes in accordance with your will. So if you were to tenancy in common, you would be at risk of 50%, say it's 50% each.
Instead of 100%, correct? So
yeah, it's better than 100%.
Yeah, you're quarantined.
But what I would do if both, so if the husband is just working in the business, the easiest thing is to just cut him out, and and the husband owns 0%.
Yeah, but what if they're business?
Yeah, if they're both working in there, I wouldn't have it in your names. I would have it purchased in a family trust.
Okay. And you do.
I'd go straight to.
Obviously, they'd want to get the tax deductions, so you'd go straight to the unit trust that you explained before.
Yeah, we could go to a unit trust. Depends. Is this an investment property or your main residence?
Investment property.
Investment property. Yeah, I'd go for a one of these unit trusts. That's what I'd go straight to.
Mm-hmm.
And then we would have, we'd go back to here. Go back to this one. I'd go for a capital protected unit trust.
Adrian, do you mind sending me those diagrams when you finish so I can put them in?
Of course. Yep.
Now, Ken's got a question, and I might be able to answer this one. So I've just signed a contract on a property through Positive Property last week, but it won't be settled for several months. Is it too late to use this structure? Ken, first thing to do is probably book in a chat with Adrian or his team to make sure the structure is going to suit you, because it all depends. But also, if you've signed a contract, we may have a possibility of getting the legal team to change the contract over, because in Queensland, it's different to South Australia, Adrian, where you can't do annual nominees. You have to actually put the actual person or the entity in the contract.
Correct.
But I've seen it quite often happen where people, I had one of our clients do this a couple of months ago. He decided, he had it in his name, decided to put it in a trust, a family trust. You actually dealt with this person. And what he did, he wrote to the lawyer and they just redone the contracts. And it worked.
That's it. That's the way of doing it.
Yeah, so we could probably easily redo the contract if you needed to, but I would suggest talking to Adrian and his team first.
Yep. So now
Does Adrian have a special rate for black belt members? Good question.
Now, George asked for a favour for me, I said, what could you do for members? And I said, look, I'm happy to have someone of my from my team have an hour chat with one of your black belt members at no cost. So I usually charge $450 an hour plus GST. So that's like this is a very valuable thing. Happy to have a chat, run through with what you're doing, and see if that's of assistance. So
what's the best way to book in with you, Adrian, or your team? Should we organise?
I would send an email to admin at cartlandlaw.com. Thank you, Liz. Admin at cartlandlaw.com, and say, look, I'd like to book in a time with someone to talk about asset protection. Say that you're one of the black belt members, and we'll arrange the whole thing.
Adrian, I'm so grateful for that. So thank you so much for doing this for our members, because I really appreciate it. I think everyone else does too.
Thank you, my pleasure. Now, there's another question from. Thank you, Belinda. Belinda said, do the banks then need to be involved if you put it in a unit trust after signing contracts? Yes, the banks need to be involved. You're going to need to tell your banks, like if you're transferring something into a trust, or if you're purchasing it in there, you're going to need to tell them about it. Now, here's one thing that I have banged my head against the wall for years, and I have found like the coolest like fix to this recently. So, is this being recorded?
Yes, it is.
Is this being distributed widely?
No, only to black belt.
Okay.
No one else. No one gets this. This is the private innocent.
Okay. Good. Okay. So, banks often have documents reviewed by their internal lawyers, but they are generally often like law clerks who have no idea what they're talking about. Now, I'm a trust lawyer for a living. I'm the chair of the Society of Trust and Estate Practitioners. I'm on the committee for the Trust and Estate Practitioners. In South Australia, heavily involved in this. I know a lot about trusts. I've written my own trust deed from zero, from a blank piece of paper. Now, I have for years had idiots, and I've written some articles on this, of lawyers or baby lawyers who have no idea what they're talking about, cause problems with me in banks. And even for just vanilla things, someone has a trust involved. As soon as you're successful in business, you have some trusts in your structure. And then I've had lawyers say, we need to like resettle the whole trust, which means tax on everything. I've said, I've had demands to have dead people sign off the trust deed. I've had just total misunderstanding about the basics of trusts. That is to say, people like lawyers purported like who know less than what you guys know now after an hour seminar, and they apparently do reviewing this. Now, here's my secret that I found like only a few months ago, is that for a number of banks, you like if you present your trust deed, it doesn't need to be the bank's in-house lawyers or recommended lawyers that review it. And I found that and so the broker can say, I want a lawyer to review it, and they ends up having a form that says, I'm a lawyer, I have reviewed this trust deed, it does XYZ, which the bank requires, and they sign off on it. Now, there are certain things that lawyers generally don't do, which is sign off on guarantees. This is not a guarantee. This is a review of the trust deed, and I worked this out just by accident 6 months ago, and found out that I could do it, and I was so pleased. I went to like a whole bunch of clients, and they had all of their trust deeds stuck with the bank. And I'm like, cool, I'm going to review it. I'm going to tell the bank that this is fine, and it was done. And the bank says, cool, like they have someone who's clever, who knows what they're doing, actually review it. And I was like, I'm not taking any risk. Like, I know what the trust does, and if I say that this person, the trust has the ability to borrow, has the ability to lend money, to buy property, then it does.
Yep.
So often banks come back with just stupid things because there's someone who doesn't know what they're talking about doing this. So that is like, if you have problems with the banks and the trust, I have I've had a lot of fun, and I found out like a bunch of tricks to get through them. Because trusts, like, what you can really get into this, there's a difficult position, accumulating wealth. So if you're really successful, like when clients who have, who have dozens of trusts and companies, and dozens of properties, the banks don't give them problems, around things like the contents of their trust deeds. Like, it's really easy. When you're a cop and a teacher buying your principal place of residence, you don't have any trusts involved. When you're trying to accumulate wealth, then suddenly that's when you can, you start getting into, I'm going to buy it in a trust, and a bit, but not a lot. That's the people that the banks try and push back into the vanilla path to being a salary owner. There's actually a lot of pushback from institutions to try and push you into that salary owner, and not getting your cash and your money out before, like spending money on a pre-tax basis, getting it, having the more like suitable structures. And it's because someone in a bank just wants to stamp it and not think, and they don't care whether that causes risks to you or not. I wanted to, I'll give that, like, heads up that there can actually be some pushback. And this is why you need people who are confident around you. Like, I have pushed back against this so many times. And I know that when a bank says, oh, here is this clause, I'm not going to change, I don't want to lend money to his trust, I push back and say, you're an idiot. Like, put someone who knows what they're talking about. And I'll actually send you an article that I wrote after the session, where I've listed a whole bunch of like dumb things that I've had lawyers tell me. So please don't mention, don't distribute this, but you can distribute the article.
Okay, excellent. Thank you for that. Look, from firsthand, obviously, Adrian's my personal tax and asset protection lawyer, and we had several years ago, I was getting some loans, and it was all in trusts, and they sent me all these guarantee letters. Remember that big pile that I had? It was massive.
Yes.
And they sent a whole box, and Adrian said, George, just tell them where to go. We're not signing anything. And I did, and they said, okay, you can have the loan anyway. But they were actually pretending that they wouldn't give me the loan without all these guarantees and guarantors and stuff like that.
Yep.
It's fascinating what you can get away with when you know what you're doing.
Yeah. Oh, yeah. It's just a bit of a push. Now, we had a question from Ravi here. He's already got a family trust with a corporate trustee. Do I have to change anything in that structure, like creating a unit trust under that, or is it a new job to have a unit trust? So this really depends on what kind of property you're purchasing and what tax profile it's in. So if you're positively gearing a property, it's totally fine to have it in the family trust. If you're going to be negatively gearing it, you're going to want to use a capital protected unit trust. And a capital protected unit trust is not something you can find on the internet. I want to tell you that.
Yeah, so I suggest the capital protected unit trust because everyone on the program's using our depreciation to get our cash flow, so we need to do that anyway.
That's it.
Yeah.
So these are really sexy. Like, I just want to say, I have put a lot of time and money into developing these, and they fit. They can help you if you've got a business, you've got money in your company. So there's a whole bunch of rules that try and stop you from paying just the corporate tax rate. So if just say you've got a business and you're paying 27.5%, which is much better than 46.5% plus the Medicare levy on the top marginal tax rate. So you say, cool, I'm paying 27.5%, and I want to spend that money to buy a property. There is actually a whole bunch of rules called Division 7A, which prevent you from doing that, or try and tax you on the way out, and basically force you to declare a dividend and pay tax. And now what we do instead is we can purchase the property in one of these capital protected unit trusts. We can actually pull the money out of that company without having to pay tax on the way out. So you still pay 27.5%, but you don't have to pay top-up tax, which makes it amazing. And so we can use these to not pay top-up tax to get your principal place of residence land tax exemption if it's your principal place of residence. We can use this to negatively gear it if it is a negatively geared property. We capital protect it. It ticks all of these boxes. And what I wanted to just finish with is I was showing before about, let's just say I have a family trust or a capital protected unit trust, but I'll just say with a family trust. And let's just say it owns your principal place of residence. So just say you haven't thought so much about tax consequences. Now, I want to say for land tax, if you actually, instead of having a corporate trustee, you have an individual trustee, you might be able to get the principal place of residence exemption. If you have one individual trustee. Now, if you have, but let's just say you're renting this out to yourself, when you sell this, and this makes capital gains, you will not get the principal place of residence exemption because it must be in your name. So, but we have a special type of lease that I call the main residence lease. Okay, and this is not an ordinary lease. This is a lease that says all of the capital gain that you make on this property has to be paid out to the tenant whenever you sell this. So what actually happens at tax law is that you make a capital gain on the lease rather than on the house here. And now you're making a capital gain on an ownership interest that is a house that is your principal place of residence. Then you get the main residence CGT exemption.
Wow.
Bam. Yeah. So that is that's how we can combine a whole bunch of tax structures. So, like, for example, I've just set up a number of people who have like their main residence in a capital protected unit trust. They have actually, because their main residence, they don't care about gearing, about negative gearing. So they have one capital unit in their name that gives them land tax. They have, say, $1 million of income units issued to a company, issued to their business, which is how they've got their money out of their business. They then have a main residence lease, so they get capital gains tax exemption, and then they have, and because it's in a trust with a capital protected unit, they have asset protection. Bam, big four.
Wow, pretty mind blown. That was amazing. Look, guys, when it comes to asset protection and tax, Adrian just runs rings around most people in Australia. He knows his stuff.
Oh, thank you, Belinda. Yes, yeah. Look, there's a lot of like this stuff can be very complex, and I do this for a living, and I don't do other things. So I'm happy. Yeah, so like this is why I know this inside out and backwards. Now I just saw a question from Ken. Is it question above? And so Ken's question was, will the use of a family trust make it easier and cheaper to move our investment properties to our children when we die as part of the will? Well, yeah, so actually, so interestingly, if you pass the properties, so you can make wills directions, as I was talking about, or we can leave control of the trust as part of your estate planning. Now, first of all, it will not form part of your will, assets in your trust, if it's set up correctly. And so that means that if your children have an expensive fight over this, or you have an ex-spouse who's trying to make a claim on your estate or whatever, they cannot attack the assets in your trusts. They're not part of your estate. So first of all, it can make it a lot cheaper because no one can attack it. Secondly, you don't need to transfer it. There's no probate fees. It doesn't go part of like the assets for lawyers in probate. It just continues on. There's no disposal. There's no capital gains tax event. And now you might need to think about it, whether it's your main residence, and so we want to have these main residence leases and other stuff. But like I have no assets in my name. I mean, I maybe have like my phone. Actually, no, my phone's owned by my company. I have nothing. So if I went bankrupt, like I don't, like everything's protected. And
you went bankrupt, your wife would have to buy another phone, another laptop, wouldn't you?
Exactly. How is my company protected? Oh, because my company, the shares in my company are owned by a discretionary trust. And that is the default setup for all trusts. Like if you're purchasing you should have a family trust, which then owns the shares in your company. That is structuring 101. And the reason why you do that is because the company is going to pay 27.5% tax, which is great. Then you're going to have, then if you pay dividends out, you can then stream those from the family trust out to different people. And the family trust, the shares in the company are owned by the trust. And so that is separate to all of your other assets. Like, so it's, if you went bankrupt, you don't have the assets taken. So that is, that's business structuring 101. Oh, and we've got
one more question from Lisa, if you don't mind reading that out. And I think
sure.
We may have time for one more question. That's it, guys. We're gonna.
Cool. So, hi, Lisa. So you said this is pretty complex. Who manages it all, and at what point is it necessary, viable in regards to cost versus ROI, and how does an SMSF fit into it all? Great question. So, so first of all, these things are generally set and forget. Now, part of the reason why you give advice, like where you come for advice, is because I'll say, here is the thing that is suitable to your circumstances. And I have had plenty of people come through and they say, I want to do something. I just say, no, this is not suitable for you. Now, and I can tell you some of these things, like these things don't even make it onto my complex structure list. Like I have stuff that is 10 times more complex than this. I have stuff that like other lawyers will look at and be like, holy crap, that is insanely complex. I have people say that those exact words, as insanely complex. So, and for those complex structures, I say to people like, it's very important as part of the advice is go, this is suitable for you and this is not, because I have seen people have structures that are more complex than is appropriate for them, totally flounder. Like it just makes their administration difficult. It makes, they don't do them properly. Then if you don't maintain the structure properly, then you can actually end up stuffing up the asset protection and the tax benefits that you wanted to get.
Absolutely. So managing the ROI on the cost is very important.
Yep.
That's one thing Adrian's very good at, because you're a commercial lawyer and you understand it's all about money. There's no point spending too much money to, there's no point. It's a waste of time.
I usually work on a rule of 10 to 1. If I say to someone, I'm going to cost you $1,000, I'm going to charge you $1,000, and you're going to save $10,000 to $20,000, like that's fine. Like that makes sense. If I said I'm going to charge you $5,000 and it's going to save you $10,000, it's like, well, is it? It's not really that sort of worth. Like, is it really worth it? So like I'm not going to lie. Like I'm expensive. Why? Because I deliver value 10 to 20 times what that is. And if I'm not going to deliver that value, I say, I'm sorry, like this isn't suitable for you. So like, my cousin, my hypothetical cousin, do actually have a cousin who's a cop married to a teacher. You know, I have a cop married to a teacher, and you know, they say, "Hey, Adrian, you know, I want to set up a land tax unit trust. You know, it's for our principal place of residence." I'd say, "Really? Do you really want to? Like, I don't really, you know, I don't really see the need for that." So now, in terms of this stuff, all the things I've talked about today, you would generally have your, we would set this up together, and then you wouldn't see me again. You wouldn't see me again for 10 years, or, you know, until something breaks. Your accountant will typically manage this. Like all of the structures we've gone through here today are easily managed by an accountant. These are all very, very common, or to the extent that they're not common. For example, the main residence leases and the capital protection unit trusts, we'll usually do a letter of advice that explains how this is, so that you can set and forget, and you can put it in your bottom drawer and go, I don't need to touch this until things break. That's your insurance policy. So that's you know, in terms of RI, and in terms of self-managed super funds, yes, that's something to add into the mix. The difficult, like, I think self-managed super funds really up the level of complexity, because they're like superannuation law changes radically every 18 months on average, and has for the last 20 years or 30 years. Every 18 months. So you and the government, like, well, so the industry super funds hate self-managed super funds. There's a lot of attack. Like there's lots of people who don't like it for their own political reasons, and so there's a lot of complexity. There's a lot of juggling around. Family trusts, the stuff that we're doing here, has been around for 50, 80 years, like, and is not going anywhere.
Excellent. Well, look, guys, thank you everyone for joining us tonight. Adrian, I really appreciate you, you know, spending 2 hours with us, 1 hour on the Facebook and 1 hour here. So thank you so much. You're an absolute legend. Keep up the good work and enjoy your evening. Thank you.
Fantastic. Thank you, guys. Thank you, George, for having me. Thank you, everyone.
Thank you for listening. I'm grateful for all our listeners around the world. If you found this podcast valuable, please share with someone that might find this useful, and please join our tribe of purpose-driven investors, increasing income and impact in our Facebook group, Positive Property. Please note, with a multi-million-dollar property portfolio and a passive income, I've become incredibly successful in investing in property. The fact of it is, however, many people may find investing in property challenging. It's not easy, and it takes a lot of hard work. However, becoming educated to make an informed decision and having the right advisors gives you the tools you need to succeed. The most important part of this formula, however, is to actually take action and apply that knowledge. It is important to understand the information I share is of a general nature only and is not taking into account your unique circumstances. If you're considering investing in any asset class, you need to seek the advice of an independent professional advisor who will be able to look at your specific situation. Be sure your advisor has actually achieved the kind of results you're seeking. Many won't have, so beware. We've taken great care putting those educational resources together. We'd be surprised if you didn't find any errors or omissions. If you do, our legal team says we have to say we're not responsible for those. In fact, as with all things, even your success, we're not responsible. That responsibility always has and always will come down to you and the actions you take. We're passionate about supporting you in that process and helping you increase your ability to create wealth, live the life you desire, and provide all the things you dream of for you and your family.